so let us continue from where we left off. We were in the process of talking about delta gamma neutral portfolios, how we can construct a portfolio which is delta neutral as well as gamma neutral. Now, obviously, a single position cannot be delta neutral and gamma neutral, in the sense that you may have to add something to make the portfolio neutral on both the counts. You can construct it, as you know, you can construct a delta neutral portfolio comprising of the position whichever you have, let us say a call option, and delta units of the underlying asset. But this portfolio need not necessarily be gamma neutral, it need not have a gamma of 0. So, the problem arises if I am given this portfolio comprising of calls and the underlying asset in such a way that say the delta is 0 or the delta has any particular value. How do I construct a portfolio which is delta neutral, that is has a delta of 0 and also has a gamma of 0. The advantage of this portfolio would obviously be why do we want this portfolio? The advantage of this portfolio would be if gamma is 0, that means curvature is 0. If the curvature is 0, that means the delta is not changing. In other words, what will happen in this case, this type of, if we are able to achieve this type of portfolio, is that delta would not change over a more significant range. If, for example, if delta is 0, gamma is not 0, that means even at the given point the call price curve has a curvature, and therefore, even the slightest stock price move will affect the value of delta and the portfolio will go out of phase, the portfolio will be imbalanced. However, if at the given point delta and gamma both are 0, that means we have more leeway, the portfolio becomes more robust in terms of rebalancing. Delta would be delta would remain or the delta neutrality of the portfolio would be preserved over a relatively larger movement of the stock price, and we need to rebalance it at a lower frequency. So, that is the advantage of constructing a delta gamma neutral portfolio, provided we can do that, and indeed we can do that if we have options of trading on the market in which we can take positions. How to do it? Well, what we do is, given a certain portfolio, we first make the portfolio gamma neutral by taking positions in options which are trading in the market. By taking either long or short positions in options trading in the market, we make our portfolio have a gamma of 0. Once our portfolio has a gamma of 0, it may or may not have a delta of 0. Now, if the portfolio does not have a delta of 0, what we do is we take positions in the underlying asset, and each position in the underlying 1 unit of the underlying asset contributes 1 unit of delta to my portfolio. A long position gives plus 1 delta and a short position gives minus 1 delta. So, whatever the delta is after making the gamma 0 can be neutralized by taking long or short positions in the underlying asset, and we can finally construct a portfolio which has a delta of 0 and a gamma of 0. Let us take an example to illustrate this. A bank's position in options, there is a portfolio of options, and it has a delta of 300 and a gamma of 140. There is an option trading in the market that has a delta of 0.60 and a gamma of 0.70. How can I make my portfolio, this portfolio which has a delta of 300, gamma of 140, how do I make this portfolio delta neutral and gamma neutral? Well, the first thing I do is I make the portfolio gamma neutral. My portfolio gamma is 140 and my option gamma is 0.70. So, what do? I short 200 options X to make the gamma of my portfolio equal to 0. So, when I short 200 units of the option X, the gamma of my portfolio including these options, short options will be 0. What will be the delta now? The delta will be 300 minus because you are shorting the options. Per option the delta is 0.60, for 200 options it becomes 120. So, 300 minus 120, now my delta for my portfolio after including the short positions in options X is 180. So, to neutralize this, I will neutralize this delta 180, I neutralize this by shorting 180 units of the underlying asset, 180 units of the stock. Now, please note, a long or a short position in the stock does not contribute to the gamma of the portfolio. Why? Because gamma of a stock is 0, delta is 1, gamma is 0. So, because the gamma of the stock is 0, it does not contribute to the gamma, it reduces delta because it is a short position, and I can neutralize this 180 delta by shorting 180 units of this stock. I end up with a portfolio which is delta neutral and gamma neutral. Now, let us understand what happens. Let us understand the implications or the impact or the relevance of gamma in the context of hedging quantitatively. We start with the same situation that we did in the Black-Scholes model. 1 unit of the derivative, let us say it is a call option, and minus del C by del S, this is nothing but delta, please note this is equal to delta. So, delta equal to minus del C by del S units of the stock. This portfolio, let us call it pi, capital pi, therefore, it has the value C at a given point t equal to 0, it has the value C 0 minus del C by del S at this particular point into S 0. I repeat, the value of the portfolio is equal to C 0, that is the value of the derivative at t equal to 0 at a given point into del C by del S at this point. Remember, it is variable. So, at this point its value is 0, whatever its value is, into S 0, which is the value of the stock at this point. I write this as C 0 minus del 0 S 0, where del 0 is nothing but del C by del S is at the point 0. This is del C 0 minus delta 0 S 0. Now, what will be the change in value of this pi when the stock changes by a small amount ds in S in time dt? What will be the change in value of pi when the stock changes by ds in time ds in time dt from its initial value S? Well, d of pi 0 will be equal to d of C 0, that is the change in value of the call option, minus del 0 into ds 0. Del 0 we are assuming that, you see, because our portfolio composition is not changing over this interval dt or during the price change ds, therefore, we are assuming this del 0 remains unchanged into ds, because I reiterate, my portfolio composition is not changing. What will be the new value of delta? That is our next question. So, delta 1 is equal to delta 0 plus d delta 0, the change in value of delta. And what is the change in value of delta? That is delta 0 plus the rate of change in value of delta, which is nothing but gamma into change in stock price, which is ds 0. So, change in value of delta with respect to S into ds 0, this is the value of d delta, the change in value of delta. So, my new delta is delta 0 plus gamma 0 into ds 0, this is my new delta after the change in the stock price. Now, to retain delta neutrality, what do I do? To retain delta neutrality, I have now to change z, because delta has changed, therefore, I have to rebalance my portfolio to make it delta neutral once again. Now, what do I need? I need 1 unit of the derivative, which is still with me, but I need to change the stock position from delta 0 to delta 1, and changing the stock position from minus delta 0 to minus delta 1, because they are short. So, changing stock position from minus delta 0 to minus delta 1 calls for a change of minus gamma 0 ds 0 in the stock portfolio. In other words, I will have to short gamma 0 ds 0 units of the stock to make the stock to make the portfolio delta neutral once again. I have to short this many units of the stock to make the portfolio delta neutral at the new price S plus ds. Now, if I have a positive gamma, and the stock price has increased, so ds is positive, gamma is positive, then what does it say? It says that I have to short I have to increase the short content. See, this whole expression becomes positive when this negative sign says that I have to short it, that I have to increase the short content of the portfolio. That means what? That means, remember, the price has gone up. So, when I am increasing the short content, that means I am selling at a higher price. This is the very important thing. I am now increasing the short content. Increasing the short content means selling more of stock. If I am selling more of stock, but the price has gone up. So, I am selling at a higher price stock which I had bought at a lower price in some sense. Therefore, I am making a profit. To make it more explicit, let us look at the other situation. Let us look at the situation where the stock price has gone down. If the stock price has gone down and you have a positive delta, what does it mean? It means that this whole expression is positive. And if this whole expression is positive, that gamma minus gamma 0 ds 0 is positive, that means you have to increase the long content of the stock. In other words, you have to buy stock. So, if the stock price has gone down, you have to buy stock. But remember, the stock price has gone down. The stock price has gone down, you are buying this stock, you are earlier short sold this stock. So, in other words, you are buying stock at a lower price and you had earlier short sold the stock at a higher price. So, you are making profit. So, in a sense, if you have a positive gamma and the stock price moves and you want, see, now let us enumerate the conditions. The gamma must be positive, the stock price must move, either it may move positively or to the positive side or the negative side, and you must rebalance the portfolio to attain delta neutrality at the new position. If that situation is created, then you end up making money. Let us take an example to illustrate this. This will make it very clear. A bank's position in options on a stock has a delta of 3000 and a gamma of 800. It has a portfolio of options, it has a delta of 3000 and a gamma of 800. The stock price is at 90. So, the first question is, what position would you take to make the portfolio delta neutral? Well, it is straightforward, because the portfolio has a positive delta of 3000, I was short 3000 units of the stock, that will make it delta neutral. After a short period of time, the price moves to 93. What is the new delta? And then he says, what is the new delta? What additional trade is required to make the portfolio delta neutral once again? And then there is a third part of the question. The third part of the question is the stock price again makes a move down to 91. That means, from 90 it had gone to 93 and now it goes down to 91. Assuming that the bank again sets up a delta neutral portfolio, examine whether the bank has lost money or gained money. That is the big question. So, the first part I have already answered, because the delta is positive 3000, I will short 3000 units of the stock to make the delta minus 3000. What is the new delta? New delta is equal to old delta plus gamma into change in the stock price. Gamma is given as 800, change in the stock price is 93 minus 90, 93 minus 90. So, that is 3. So, 3000 plus 800 into 3, that is 5400. This is my new delta of the position. Hence, now therefore, in order that the portfolio may again be made delta neutral, I need to be short 5400 units of the stock, but I am short only 3000 units of the stock. So, I need to short 2400 more units of the stock. Since I was originally short 3000 units of the stock, I need to short 2400 more units of the stock. This will be done at 93. Right. So far so good. Now, the stock price changes back to 91. So, what is the new delta? The new delta now becomes 5400 minus 800 into 2. We are assuming that gamma is not being changed by because of the small price movements. It is not it is remaining at 800, although it would change marginally, but 5400 minus 800 into 2, that is 3800. So, my new delta when the stock price goes to 91 will be 3800. And therefore, if I want to remake the portfolio delta neutral, I need to be short 3800 units of this stock. And I am already short 5400 units of this stock. So, I will unwind my position, I will unwind my short position to the extent of 1600 units of this stock. I will buy 1600 units of this stock that I have sold earlier. Now, I had sold this 1600 units of the stock at 93, recall that. I had short sold this 1600 units of the stock at 93. I am now buying back that 1600 units of the stock at 91. So, I am making a profit of 1600 into 2, which is 3200. Now, gamma when you buy, that is why it said, you see, the first thing is when you buy a call option, gamma is positive. When you are long in the call, gamma is positive for you, and when you are short in the call, gamma is negative for you. Now, you see, there is an important issue here. The important issue is, I have just shown that you make a profit from this strategy of maintaining delta neutrality if the stock price goes up or the stock price goes down. Now, obviously, this cannot be true, it has to have a catch in it. We will come back to this catch after discussing the next few Greeks. So, these are some gamma positive strategies: long call, long put, long straddle, long strangle. All of this we have talked about when we discuss trading strategies. These are gamma positive strategies. The converse of them, or the mirror images, are the gamma negative strategies. So, let us summarize what we discussed. Gamma measures the rate of change for delta with respect to the underlying asset price. All long options have positive gamma, that just now I mentioned. Short options have negative gammas. Gamma of a position tells us how much a $1 move in the underlying asset will change, that is the sensitivity, that is the partial derivative, you may call it what you like. In Black-Scholes model, put and call options have the same gamma. The gamma is maximum for ATM calls as it approaches 0 on both sides, as you go in the money or you go out of the money, and as expiration approaches, ATM calls, that is at the money calls, tend to increase. Gamma tends to increase very rapidly and very significantly, whereas in the case of OTM calls and ITM calls, gamma approaches 0. When volatility is low, the gamma of at the money options is high, while gamma for deeply in and out of the money options approaches 0. I have discussed that because the time value of in the money and out of the money options is small. If volatility is low, the chances of their jumping from their respective domains in the money or at the money into any other domain is very unlikely, and therefore, that being the case, the changes in their prices and the changes in the delta are very small. However, if volatility is high, then there is a significant chance that an out of the money option could jump into an at the money situation or even go into the money and vice versa, and therefore, if volatility is high, the gamma variation is relatively well distributed across the entire spectrum. If gamma of a position is small, as I have discussed many times, rebalancing is required at infrequent intervals. If gamma is large, rebalancing is required at frequent intervals, and positive gamma can be used to book profits provided you want to retain delta neutrality. Now, we come to the next option Greek. The next option Greek captures the impact of time on the option price. What happens to the option price as the option approaches expiration? That is the big question. So, the sensitivity of the option price, sensitivity of the call price or the put price or the portfolio price to the passage of time. When we talk about passage of time, we basically refer to time elapsed, although we can also work out the theta or the equivalent of theta in respect of time remaining to expiration, because obviously the two are interrelated inversely. Increase in time expired would obviously reduce the time to expire and vice versa, and therefore, the normal practice is to work theta with respect to time expired rather than time to expiration. So, theta of an option is the rate of change of the value with respect to passage of time, with all else remaining the same. It is the partial derivative with respect to time expired, and that is and what is this t is the time expired, capital T is the time to maturity, and therefore, t minus t is the remaining time. Capital T is the total life of the option, small t is what has already passed. So, t minus capital T minus small t is the time to expiration, but delta is usually worked out with respect to small t. So, if delta is usually worked out with respect to small t, as you can see from here, it is usually negative. Why is it negative? Well, it is common sense. As the maturity of the option approaches, as you move towards the maturity of the option, what happens to the value of the option? The value of the option is likely to, other things remaining constant, of course, the value of the option is bound to decrease. Why? Because the time value of the option, you see, part of the option value is attributed to the uncertainty or the fluctuation in the price of the underlying, as a result of which the payoff is uncertain on the option. And because the payoff on the option is uncertain, and as we move forward in time, that uncertainty gets less and less, or gets squeezed into a small period of time. Therefore, the value of the option diminishes as it approaches maturity, and therefore, the negative sign here. So, theta is usually negative for a long option. Of course, if you have a short option, you are going to benefit from it, and therefore, theta would be a positive quantity. Theta is usually negative for, and this is because as time passes, the option tends to become less valuable. Right. And theta is usually expressed in terms of dollars or money units per year, or you can also express it in money units per day. That depends on the choice of units. You can express in money, whatever money units and whatever time units. Basically, it is money units per time unit. So, it reflects the amount of decline in the value of the option per unit time. That is apparent from the fact that it is a partial derivative with respect to time. Now, theta and stock price, it is negative throughout. As the stock price approaches 0, you can see that the theta approaches 0. Obviously, if the option is completely out of the money, and there is very little chance of the option bouncing back into at the money, then the option price is not going to be affected by passage of time. It is going to remain close to 0 itself, call price, and therefore, in that scenario, the value of theta would also be close to 0. However, there is a limiting value when the stock price increases. And as the stock price approaches infinity, the asymptotic value of the call option theta approaches this value, which is given by this expression. Please note, it is negative, but it is less negative than the maxima. It is not the maximum value of theta in terms of magnitude. It is not the maximum value of theta in terms of magnitude. It has a finite value, non-zero value, and that is given by this expression. So, in the money option, you have a finite value to which the option theta approaches, and maximum value of the option theta is close to its exercise price. In other words, at the money options have the maximum theta. Out of the money options have a theta which is pretty close to 0. In the money options have a theta value which is close to this expression. Now, theta and expiration, again this is very interesting. We talked about gamma and expiration, and there I mentioned that as we approach expiration, at the money options tend to have high positive, substantial positive gammas, look at what happens to theta. Let us look at the money options. This is the other two curves are relatively straightforward, but look at the money theta curve. As you are approaching maturity, as you are approaching expiration, theta is getting larger and larger negative. Why is this? Because again the issue of time value comes into play. At the money options have significant time value, and when you see at the money options have significant time values, at maturity the time value has to be 0. Therefore, the significant time value has to be amortized over a smaller period of time as you approach maturity, and therefore, the thetas have a significant negative value for at the money options. Compared to out of the money and in the money options, you can see that this has a totally different structure. I will read this out. Theta values are negative for long calls, that we discussed it. Initially out of the money have a faster rate, that is this portion, this area. Out of the money a faster rate of time decay or theta decay than at the money options, that is far away from expiration. But as you approach expiration, at the money options completely override or completely they completely overshadow the theta for the out of the money or in the money options. They become they can have very negative theta. Here in fact is a catch to the issue that I raised earlier. We will come back to it. Theta based strategies. Option sellers use theta to the remember a long option has a negative theta. So, what will be the theta of a short option? The theta of a short option will be positive, and if the theta of a short option is positive, what does it mean? That means as you are approaching expiration on a day to day basis, the value of the call is declining, and therefore, you are recouping, in a sense you are recouping your premium, and therefore, option sellers would benefit by a large theta. Because option buyers will have a negative theta, option sellers will have a mirror image of that, they will have a positive theta, and because of the positive theta, the rate of increase in option value as far as they are concerned would be high, and they would be recouping their premium very rapidly. Let us look at the next one. Calendar spreads involve buying a long dated option. Now, again it is a long option, it is a long dated long option, you have taken a long position in a long dated option. You see calendar spread, if you recall, what did we have? We created the spread here, we had a short call that matured at this point, let us call it T1, let us call it 0, and we had a long call which matured at T2, T1 was less than T2. This was short, this one was short, and this one was long. The long maturity option was long and the short maturity option was short. Now, the short maturity option will have a larger theta and it will be positive. Because it is a short position, so theta will be positive, and because of the short maturity the rate of amortization would also be more, and therefore, theta would be positive and larger. In this case, theta would be negative and smaller. Therefore, by creating this position, as far as the theta is concerned, you would be having a net positive theta. And as a result of which, because this short dated option expire faster, you will benefit from the positive theta. In other words, as you approach the maturity of the shorter option, your portfolio would be increasing in value. Other things remaining constant, this is important, very important, other things remaining constant. If stock price changes, then it may well happen, it may very well happen that the changes in the portfolio, the changes in the portfolio value due to the change in the stock price could well overshadow the changes in the price of the portfolio due to the passage of time. Where can, so therefore, again what does it translate to? It translates to a gamma versus theta fight. If the gamma is high and positive and theta is high and negative, then what will happen? A change in the stock price will give you profits from the gamma, but and if the change in the profits is rapid, the loss due to the negative theta would be small. So, if you have a long position with positive gamma and negative theta, it is basically a gamma theta fight, and gamma being positive would be would yield profits if the stock price fluctuates more, and if the stock price remains stable, then the gamma profits will not materialize, but the negative theta will eat into the value of your portfolio. Conversely, if you have a short position with a negative gamma and a positive theta, what will happen? The negative gamma will result in losses if there is a swing in the price of the stock, but the positive theta may recoup some of it, but if there is no swing, then gamma losses will not occur, but the positive theta will generate profits. So, gamma theta fight is one of the very interesting issues that you have in option trading strategies. So, this is what I was talking about, gamma theta trade off. You buy at the money options close to expiration, at the money options close to expiration you are buying them, that means you are buying a positive gamma position, high positive gamma position at the money options, high positive gamma, they are close to expiration, even higher positive gamma, and therefore, your gamma has a significant positive value. It has a significant positive value, there is a change in the price of the underlying, it will generate high profits. What happens if there is no change in the price of the underlying, a very small change in the price of the underlying, then gamma profits will come down, but theta being negative, because if you are having a long option and if you are having it close to the expiration, you will also have a negative theta, significantly negative theta. In other words, this position would be eaten away, would be amortized very quickly as you approach expiration. So, if the stock price does not move, you lose heavily on account of theta or time decay. When you sell, invert this strategy, that is you sell close to expiration options, you create a negative gamma position and a positive theta position. So, it operates in the inverse manner. So, this is about gamma, and so negative theta versus positive theta. Now, theta values are negative for long calls and vice versa, positive for short calls. Gamma values are positive for long calls and negative for short calls. Therefore, out of the money options have a faster rate of theta decay, we talked about earlier. Out of the money, distant from expiry, distant from maturity, have faster theta decay, but as you approach expiry, they are completely overshadowed by at the money options. So, that is important. The basic strategizing comes in when you play around with at the money options, that is close or short dated options. So, we will continue from here in the next class. Thank you.